5 months and 3 days. That's all it took for China's biggest ride-hailing company, DiDi, to go from an IPO, much ballyhooed on Wall Street, to announcing its delisting from the New York Stock Exchange. I think 5 months and 3 days must be a record, but I'm sure somebody will put me right if they know another stock that did delist in a shorter space than that. It will delist as soon as possible and IPO trade instead on Hong Kong. The share price is off 22.5%, battered by Chinese regulators since going public in the United States. Just look at that. Look at that. I mean, Beijing banned DiDi from Chinese app stores this summer. That was the first bit, and that created the first fall. It was on the basis of data and security and privacy concerns. Billions have been wiped off investors, a disaster for early investors, and the shares are now worth less than half their IPO price. The decision, though, to move to Hong Kong is weighing on other Chinese companies listed in New York, because the issue will be, well, if it happened to DiDi, could it happen to them? For instance, Alibaba, Tencent, and Baidu, could they be forced out of their US listing, arguably even NVIDIA? US regulators are demanding more transparency for Chinese companies to list in the US, and China is seeming set to ban the financial loophole that allows it. Jamie Metzl is a senior fellow at the Atlantic Council and worked for the National Security Council under the former President Clinton. Well, Jamie Metzl, when I heard this, I just thought, now I've heard everything. You IPO 5 months ago and you delist with some vague promise that you're going to offer the similar shares or securities to those investors in the Hong Kong market. What do you make of it?
Well, Richard, this is a big story, but it's only a small piece of a bigger story. The bigger story is the growing decoupling between the United States and China across the board, including economically. Yesterday, as you know, the US SEC passed a regulation requiring more transparency for the accounting firms that are involved with listed Chinese companies, and the Chinese government has resisted that. I think we're going to see a lot more here, and this is just the beginning. This isn't just about DiDi. This is about economic relations between the United States and China.
Essentially, though, if we say US markets, but for want of a better word, if the Western markets become shut off to Chinese companies, sure, they can raise the same money. There's a wall of money in China that will fund IPOs there, but it puts a nail in the coffin of globalization in terms of global securities.
Well, there were many of us who maybe decades or less ago imagined that our world would follow a path of greater and greater integration, and that's certainly a very positive sign. But what we may well be seeing now is, as I was mentioning before, the beginning of a decoupling. Maybe we'll have two spheres of globalization, the US-centric sphere and the Sino-centric sphere. And that doesn't mean they'll be totally separate, but it does mean that the kinds of economic integration, whether it's through markets, supply chains, people, many other things, we are very likely moving away from a single globalization story.
So if you're holding DiDi shares and you're nursing losses, that's fine, fair enough. But at some point, you're going to have to make a decision, aren't you? Sell and take your losses, or accept whatever weird construct they come up with upon delisting and the issuance of new shares in Hong Kong.
Yeah, it's true. But if you're holding DiDi shares now, you are already holding something based on a strange construct of not really owning those shares, but only owning a share of something held in Caymans that was basically an interest in profits from shares in China. And yes, this is another shenanigan. But yeah, there are some people who will hold on to their DiDi shares if they can, if they have the stomach for it, and there's a chance that they'll make a little bit of money. But the bigger question is this a foundation upon which to rest international economic and market relations? Because anybody who is buying any Chinese company share listed in the United States, basically you're putting your faith in the Chinese state, which is not looking out for American or international investors.
Answer your own question. You just asked the question, is this? Well, answer it. What do you think? Is this such a gobsmacking reversal of anything that those of us who invest in Western markets are used to, that it essentially makes Chinese stocks in US markets radioactive?
Yes. If you are holding Chinese stocks, Chinese companies listed in the United States, you are putting your faith in the behavior of the Chinese government. And the Chinese government is making 100% clear that its interest is not protecting American equities holders, but protecting the interests of the Chinese Communist Party.
Jamie, we'll talk more. We bought some DiDi shares to see how they're going to progress, and as we move forward with this, we're going to want to we'll have to decide next year, what we're going to do with them. So you can help us. You can help us decide.
All right, it's a deal, Richard. Great to see you.
What are we going to do with our DiDi? Keep them, invest in Hong Kong, take a loss? Well, we'll discuss it in the weeks ahead.